Hello, everyone. My name is Anthony Almeida with BERYL Consulting Group, and I am pleased to be joined by Anthony Bassili, President of Coinbase Asset Management. So why don't we jump right into it and start with the macro setup. 60/40 is broken, debt is at $37 trillion, inflationary shocks are on the horizon. How should allocators be thinking about portfolio construction today?
Tony, it's great to be here. I think you're right, setting it up that way, which is we've shifted very fast this year from what we all thought was a environment where we're going to have rate reductions and lower inflation. And now we're in an environment where we have a new Fed chair who's generally pretty hawkish, and we have rising inflation due to the issues in Iran with the Strait of Hormuz and energy prices. On top of that, we also have the continued problem around monetary fiscal dominance being the driving theme for this market. And what that means is that as we have rising debt, you're going to see continued monetary debasement and easing that has to play through over time. You have still $9 trillion of debt that has to roll over this year. They're finding some success rolling a lot of that into short-term rates. But what the Trump administration has clearly outlaid is that they have to do so with lower rates. That's going to be really hard to accomplish. The last piece of this is you have structural problems in private credit, which is now 15 years mature and has trillions of dollars of capital that's flowed in. We're starting to see some cracks in that space. You've got real estate, home sales reaching levels that we haven't seen in over 40 years relative to buyers. And you also have the highs of the equity markets that are driven by generally the Mag 7 hitting PE ratios and CAPE ratios that match what we saw back in 1999 after the tech boom. So the structural mix today is very complicated for a lot of investors. A lot of money is chasing these very long duration growth type assets. And now they are producing cash flow. So it's very different than 1999. But if you look behind the curve, under the cover for those, a lot of the cash flow that's billed for mostly AI is driven by promises to pay that I think if you look deeply into the balance sheets of the AI companies and the superscalers, requires things to be perfect. And so today the markets are kind of priced for perfection. This is why when we look at portfolios today on a 60/40 basis, or even something that blends alternatives into it, you see equities and fixed income still trading very highly correlated. That's been a trend that happened. It was established during the GFC when the Fed unlocked the balance sheet. So what do investors do? What investors do is we believe that they need to establish a new asset class that we call store of value asset class. And so what that asset class does specifically is it removes gold out of the commodity bucket and it adds gold and Bitcoin as a strategic core allocation to the portfolio. And so for a lot of investors, as they think about this one specific factor, which is monetary debasement, money supply growth, which is expected and is ramping up over the course of the next cycle, that Bitcoin and gold are going to be recipients of a lot of that de-risking out of traditional equities and out of bonds, which deliver a negative real yield as well. So what people should think about today is the structural change that's happening across their portfolio. Equities, fixed income, alternatives are all experiencing a dramatic shift right now, both from a technology perspective through on-chain capital markets, from a global geopolitical perspective in terms of dollar dominance around the world. Stable coins is a major player in terms of continuing to hold the dollar's strength globally. And Bitcoin's the other major player from the crypto capital markets that has emerged that should be part of their portfolio.
Excellent. Thank you very much for that. And in terms of who is Coinbase Asset Management, can you tell us about what conviction does Coinbase Asset Management hold that the rest of the asset management industry doesn't yet possess?
The conviction that Coinbase Asset Management holds that isn't shared across the traditional asset management industry is that on-chain capital markets are the alpha play now. And this is a very new technology. It's a very new primitive, but it's not new for us. It's been around for the last 7 or 8 years in terms of using protocols and using digital assets as a core part of your portfolio construction to generate excess return and add diversification. Now, the trend of adding Bitcoin to a portfolio, passive Bitcoin, has finally emerged. And what you see is major platforms like Schwab and JP Morgan and Fidelity, Morgan Stanley and others have finally admitted that Bitcoin has a role in portfolio. And they've done so by saying that you should have 1 to 5% of your total portfolio in Bitcoin itself. That's a big structural change. What they're missing still is the unique alpha opportunities that exist during this period of transition. So we are undergoing a major structural overhaul of how our capital market systems function. We're bringing credit on chain through stablecoins and stablecoin lending. We have dollar expansion, which is now global, not just isolated to the US and through their bank partners. And people all around the world are now participating in global capital markets. That's going to be a completely revolutionary new idea for investing that most traditional investment managers just technically are not ready for.
And shifting over to the alternative landscape. Alternatives have exploded across private credit infrastructure and real assets absorbing trillions of dollars. Where does digital fit in that lineup?
So today, most allocators are looking at the digital asset space as an alternative. And they're asking this question of, does Bitcoin fit in my alternatives bucket? Should I be investing in other areas of this emerging technology primitive? If so, how do I do it? And so to date, most investors have participated either through venture, which is a private equity bucket. A lot of investors have participated in Bitcoin itself, direct passive allocations. A lesser amount have participated broadly across their tokens and other primitives that are on chain in this environment. Now, what's emerging from an alternatives perspective is, as I mentioned before, we think Bitcoin absolutely has a role in your portfolio. You can choose to put that in your alternatives bucket if you'd like, but we think it belongs in an actual carve out of store value as an asset class. The other category that we are building today is around stablecoin credit. So traditional private credit today is a really important part of the global financial system. However, we're already seeing cracks because a lot of the lending that took place in traditional private credit was done with asset-light companies that are legacy software businesses. And so they're predicated on the fact that old school software revenue generation is going to continue. We don't think that's the case. With the advent of AI, the fact that we now have things like Claude Code, where individuals can build and design the software solutions that they want at their fingertips, right? This completely changes a lot of the exposure in traditional private credit. So we think a lot of traditional private credit probably has a lot of flaws in it and will be challenged going forward. Investors should start thinking about, what is the next version of credit? How do they redeploy what was a credit allocation from companies who are being disrupted into companies who are doing the disrupting? When you think about the advance of stablecoins, which are now over $350 billion, and from a trading settlement perspective, stablecoins are competing with ACH, Fedwire, and Visa in terms of global volumes, now reaching over 30 trillion. The opportunity there is not just stablecoin settlement that competes with the dollars and banking settlements. It's actually credit. How investors should think about this in their alternatives bucket is, should I expect the internet of money to grow and there eventually will be billions of people using the internet of money? We think the answer is yes. Therefore, if people are now settling their money on chain, they're also going to want to settle their credit on chain. So that's what we're building with our funds. We're building with the blockchain technology integrated into real world applications, and payments and settlement and credit is a major, major piece of that.
I agree with you there. And something that you've mentioned throughout the interview is Bitcoin as a portfolio asset. So could you please make the case for Bitcoin to an allocator who already owns gold?
Bitcoin is a core store of value. It's digital collateral. It is inversely correlated to gold. It is a fixed supply asset that can and does travel around the world and settles instantaneously with hundreds of millions of people today. And so as you're thinking about why gold has value, gold doesn't trade at its price that to get it out of the ground, its extraction price. Gold trades at a premium because investors around the world believe that it's going to help them sustain preservation of wealth while monetary debasement takes place and other assets trade around that. Bitcoin does the same thing. Over any 3-year period, investors who have held Bitcoin have made money. Bitcoin's passive returns are one sharp or higher over those periods as well. And over any 5-year period, Bitcoin has outperformed, since its inception, every single asset class that exists on the planet today. And it's a really important fundamental aspect to look. If you add Bitcoin to your portfolio, 60/40 or any other variations of that, it has only improved sharp total return and Sortino ratios in that portfolio. We wrote a paper called Get Off Zero that we released earlier this year, and that paper looked at different types of portfolios with the inclusion of Bitcoin in it. And what happened was, in every case, over a 5-year period, you have increased total return meaningfully, you've improved diversification, you've reduced volatility, and you've improved your Sortino ratio. So the thing that investors, and as I mentioned at the opening here, that most large asset managers and banks are now acknowledging, is that Bitcoin has done a really great job to preserve wealth and improve total returns of portfolios. And that's what we think investors should be adding to the portfolio today.
That's a very compelling case. And moving on to stablecoins that you've also mentioned. So stablecoins themselves have grown to a 300 billion category, settling $33 trillion just last year. What's really happening on these rails that investors should care about?
It's part of this growth of on-chain capital markets, and there's geopolitical implications tied to that. The United States is going to continue growing its debt, and the only way they can get out of that is by inflating asset prices higher so that we can maintain a healthy debt to GDP ratio. What that means is, if you're an investor, you don't want to sit in bonds, you're earning a negative real return, you're going to have higher inflation, and you're going to expect monetary supply growth. So as you allocate capital, you want to allocate capital to the most globally accessible assets that have scarcity tied to them. Digital gold, Bitcoin, is truly that asset. It is globally accessible, fractionalized, available to anyone around the world, regardless of what country they're in. It is fixed supply asset, and there will only ever be 21 million Bitcoins to be held. So when you have large platforms buying the multiple days of available supply in this fixed supply asset, what that should tell you is there's demand, continued demand, persistent demand for a fixed supply asset. And the classic case of supply-demand dynamics come into play. More buyers means that the price of the asset should follow suit and should rise.
How can investors participate in your funds?
That's a great question. So we're investment managers, and we build products, we build funds. So we have a Bitcoin yield fund that allows investors to capture the return of Bitcoin plus excess return. Okay, and so how we do that is we use Bitcoin as collateral to add additional excess return on top of that asset. This is an all-weather strategy, so whether Bitcoin is up or down, we're able to generate excess return on top of Bitcoin's total return. We also have our fund, which is called 𝐻𝐭, which is taking in dollars, and then it converts those to stable coins, and we are lending, we're extending credit on chain so that you can have access to this credit thesis that we've talked about. But this is connected to new software and new companies building on-chain capital markets, and rather than on old companies who are tied to old school software companies that are dying.
Well, thank you so much for that, Anthony. That now concludes our interview for today. I'm sure our audience at BERYL ELITES is going to really enjoy it, and allocators in general should watch it as well. Thank you for your time today.
Thanks, Anthony.